Reuters.
The U.S. Treasury has moved swiftly to prop up troubled mortgage finance giants Fannie Mae and Freddie Mac. Shares in both companies plummeted last week amid fears they were about to run out of money. Unveiling a sweeping range of emergency measures, Treasury Secretary Henry Paulson said the health of the two lenders was vital to the recovery of the ailing U.S. housing market, currently experiencing its biggest slump since the Depression.
Fannie Mae and Freddie Mac play a central role in our housing finance system and must continue to do so in their current form as shareholder-owned companies. Their support for the housing market is particularly important as we work through the current housing correction.
The emergency plan calls on Congress to increase the company's access to credit, allowing the Treasury to buy shares in the firms if needed. Additional funds will be made available through the Federal Reserve for only the second time since the Depression. European stocks rallied in early trading on Monday, but James Hughes, analyst at CMC Markets, says the respite may be short-lived.
We're looking at the way the markets have reacted recently. Many people are thinking that it's just going to be a short-term fix and we could see the market plunge lower later in the week. Now, of course, it's going to be hard to tell exactly which way they're going to go.
The two firms were created by the U.S. government but have privately held shares. They support the U.S. housing market by buying mortgages from banks and trading securities backed by the houses attached to the mortgages. Together, they manage more than $3 trillion in mortgages and investments underpinning the U.S. economy. Fannie Mae, which is a nickname for the Federal National Mortgage Association, said its portfolio was $737 billion in May, the highest since August 2005. Freddie Mac, or the Federal Home Loan Mortgage Corporation, said its portfolio was a record $770 billion in May. Both companies are being hit hard by the U.S. property market crash. They've lost more than $11 billion in defaulted mortgages. Many fear that if they were to fail, it would precipitate a meltdown in global financial markets. Helen Long, Reuters.